This is a complete newbie step-by-step guide on the property buying process. If in the end you find value in this video, remember to hit that subscribe button. Step 1, pre-approval. Talk to a banker or broker, and by the way, choosing the wrong one could cost you big time. Later in this video, I'll explain why. In this initial meeting, they will walk you through all your costs, your borrowing power, and how much you can spend on a home. From there, you'll have a decision to make. Say you're only looking to spend $500,000 on a home, but you're able to get a pre-approval for $1 million. What should you do? Well, in this case, I'd recommend you go for your maximum. Doesn't mean you need to spend it, but if you're purchasing for $500,000 with $1 million pre-approval, then it's just fine. Reducing it is super easy, but increasing it isn't. And it's always recommended you go for a higher pre-approval than what's needed. Step 2, inspect and review. When inspecting homes, look and touch everything, know every corner of the property. At this stage, you want to identify any red flags. When I bought my first home, I entered into a contract to buy a unit and I was head over heels with its layout and never walked around the building to see what else there was. Had I done this, I would have found the same thing the building inspector did, a massive crack. And it ultimately costed me both time and money to exit the contract. Step 3, conveyancing. Before signing any contracts, you want to seek advice from a conveyancer. They will point out any strange or problematic wording in the contract. And remember, it's always best to have a finance and building and pest clause. A finance clause will protect you should the bank not approve your loan, allowing you to walk away without any penalty. And the same thing applies with your building and pest clause. While it's possible to remove both clauses to increase your negotiating power, it's important to understand that there's risks associated and there are other options available. More on this later in the video. Step 4, contract to sell. Once you have a contract to sell signed, send a copy to your broker or banker. This will get your application moving forward towards a formal approval. If you have a building and pest clause, now's the time to arrange an inspection, and it's at this point you'll transfer the deposit. Step 5, approval. With you already being pre-approved, the process of getting a formal approval will be much simpler. Typically, your bank will need to complete a valuation to complete their process. Once you're approved, your loan documents don't need to be signed before going unconditional on the contract. The bank will send you an approval letter, and this is all that's needed to meet your finance clause. Step 6, loan documents. And it's at this stage you will receive the paperwork, and it's super important you read it all. The key things to understand in this paperwork include interest rate, repayment, fees, and loan amount. Once you've signed everything, the hard part is over. Step 7, preparation for settlement. This is where your conveyancer will prepare the title transfer, allowing you to take ownership of the property. They will also calculate your funds to complete, which is the amount of money you'll need at settlement. Step 8, pre-settlement inspection. Before the settlement date, you'll want to arrange an inspection. This will allow you to look at the property, and if you discover any issues or defects, it will allow you to seek remedy. You'll do this through your solicitor. If any defects are small, you may seek a monetary compensation. If large, settlement may be delayed until resolved. Having a withholding clause in your contract will help alleviate this being a problem. Step 9, settlement date. More often than not, settlement will be completed through an online platform called PEXA. This means that you'll know exactly in real time when everything is done. Now we've got an understanding of the process. Let's deep dive into the details. What's the difference between a banker and broker? Well, close to 70% of all consumers choose a mortgage broker. There are 3 main reasons why this is the case. The first reason is options. Mortgage brokers do the legwork for you, so rather than you having to go to bank, using a mortgage broker will allow you to gain access to a wider range of lenders, saving you both time and money. The second reason is cost. Mortgage brokers don't charge you a fee for their service. They get paid upon success of your loan. It's a win for the banks because it actually reduces their costs. They don't have to pay for such things as staffing, marketing, a premises, and all the rest. The third reason is customer satisfaction. Mortgage brokers, unlike banks, don't have millions of dollars to spend on advertising. They rely on word of mouth. And if you're looking for a great mortgage broker, here at Hunter Galloway, we get home loans approved. There is no fee for our service, and we help Australia-wide. So reach out and visit us at huntergalloway.com.au or call us on 1300 088 065. Pre-approvals. There are two types of pre-approval, an automated and a fully assessed. An automated pre-approval is done through a computer program and is still subject to the bank's full assessment because they don't do one, meaning they're worthless and is best to avoid altogether. A fully assessed pre-approval is where your application is reviewed by an actual human, and once pre-approved, the only condition should be a satisfactory bank valuation. It's best to talk to your bank or a broker so you can understand what your pre-approval is and what it isn't. Know all the conditions needed to gain approval, and if mortgage insurance is involved, it's common for the bank to complete their assessment, but not for the mortgage insurer, meaning your pre-approval is still subject to meeting the lender's mortgage insurer's lending criteria and is not necessarily a fully assessed pre-approval. What happens if your valuation comes in lower than the purchase price? First, look to contest the valuation, but from my experience, it's unlikely you'll be successful. You can either proceed as is and might mean you need to contribute more money, or you can arrange further valuations with other banks. If this fails, then look to negotiate a lower purchase price or pull out of the contract based on your finance clause. How to increase your negotiating power. Firstly, be sure you've got a fully assessed pre-approval. From here, you'll look to reduce, remove, and replace terms in your offer. How do you do this? Well, option 1 is to remove. If you do this, be sure you know what you're getting yourself into. So if, as an example, you remove your finance clause, it means that even if the bank doesn't approve your loan, that you're locked into the contract. And it may mean that you're liable for hundreds of thousands of dollars. So only do this if you've spoken to your conveyancer and mortgage broker, as it's a big call to make. But if you can make it work, it will literally put you in the driver's seat when making offers. Option 2 is to reduce. This is where you'll reduce the terms to as short as possible. In most cases, if you've got a fully assessed pre-approval, you can reduce your finance clause to as little as 7 days. Option 3 is to replace. Back to the finance clause, rather than having one, you could look to replace it with, say, a satisfactory bank valuation instead. Anytime you're changing or adding contract clauses, be sure you get it reviewed by your conveyancer. Repeat this process with all other terms. A withholding clause essentially allows you to hold on to money should issues arise. As an example, say you complete a pre-settlement inspection and you find massive defects. This clause would allow you to hold a pre-arranged amount until these defects are fixed and will allow you to settle without having any delays. If you look to buy an apartment, it's important that you walk around the building to check if there's any damages or issues with the property. And keep in mind that some apartments have flammable cladding and is something you want your building inspector to review. Next, when buying an apartment, read the annual general meeting minutes and investigate the body corporate. This you'll review costs such as how much money is allocated to the administration and sinking fund each year and whether or not there were any levies raised in the past. Make sure you have enough money. Whilst this sounds pretty basic, you'll be surprised how easy it is to get this wrong. It's because there are so many other costs that pop up left field, and typically most of these fees won't be known until the very last minute. Therefore, you'll want to include a $5,000 buffer to be safe. Funds to complete. On settlement, you'll have 2 ways to pay this. The first way is to transfer your money to your conveyancer's trust account. And if you choose this, make sure you transfer the money ahead of time, at least a week before settlement. If this isn't possible, then you'll need to call your bank to assist with what's called a same-day transfer. Providing you do this in the morning for a fee, the money will be received later that same day. The next method is to elect your bank account. Not all lenders offer this as an option, and the account will need to be the same as your home loan provider. It means you can transfer the money on the same day as settlement without having to worry about funds clearing. I would recommend it as it is the safest option. Early possession. This is something you can organize through your conveyancer once you've gone unconditional and met all the contract clauses. It'll mean you'll be able to access the property before the settlement date. Different types of valuations. There are 4 different types of valuations: short form, drive-by, desktop, and automated. A short form is where the valuer will physically inspect the property both inside and out. A drive-by is where the valuer will simply drive by the property and inspect the outside only. A desktop is where the valuer will complete their research digitally, and an automated is where a computer program will complete a valuation through data. Buying at auction. If you're planning to go to auction, know you're entering into an unconditional contract. This is binding and can have huge consequences. It's best to talk to your banker or broker and conveyancer before doing anything. If this is a topic you're interested in learning more about, you can check out our other videos on this very topic, which goes in much more detail. That's all from me. Thanks for watching.